Hi, I'm Ben Solomon. Today we will talk about federal budget management. It's December 24th, and in a manner that is, we'll talk about it in a manner that is politically neutral because we need to manage our budget better without uh, interfering with the political side of the budget management. And surprisingly, I've spent some time looking at the federal budget structure, and surprisingly, I found that there were only three rules that are needed to manage the federal budget. We look at um, it's based on my experience working with financial statements and looking at how those financial statements convert into the operating behavior of the firm. And it's also based on some of the econometric type modeling that I used to do some years back, where I found that if you look at Federal Reserve Economic Data, there are about 150,000 time series available for free on the web, and it's managed by Missouri Fed, I believe. It's been a while since I looked it up, and I built models of interest rates, 3-month Treasury interest rates, and so forth. And I found that uh, what we did 25 years ago, 20 years ago, 15 years ago, 10 years ago, 5 years ago has an impact on what we are doing right now. And therefore, if you reverse that, what we do now will have an impact 5, 10, 15, 20, 25 years from now. That means it will have an impact on our children's economic environment. And so it's very important to understand what we're doing today. So surprisingly, there are only three rules um, for managing the budget well. This has not been something that an econometrist has put forward, an economist put forward, or Nobel laureate has put forward. My concern is how do we protect our people, our citizens, from abuse or misuse of uh, free money. And so I came up with these three rules: the funding rule, the disposable income rule, and the leverage rule. And, but first, before we look at those three rules, let's have a preview of the federal budget structure. Then you'll understand what I'm saying more clearly. So the federal budget consists of two portions: money coming in and money going out. And this is total receipts, which is basically money coming in, and is broken up into these categories as laid out by the Congressional Budget Office as of November 8th, 2021. So we can see that um, individual income taxes, payroll taxes total to about 85%, 83%. So the amazing thing is that individual W-2s account for 85% of the budget's sources of funds, and about 6 to 10% comes from corporate income taxes and other receipts. Together, they form about 16 to 18% of the GDP. Okay. So the important thing is individuals, W-2s, account for 85% of the federal budget. Okay, so if we look up the history, this is provided by the Tax Foundation. So we see that the blue line is the individual income tax, the orange line is the payroll tax, and together I have just lumped it as individual tax, because this is individual income tax versus individual tax. And this is, when you combine it, you get this yellow line, which is the total taxes that comes out of your W-2. Notice that whatever our politicians say about increasing taxes or decreasing taxes, it's here on this blue line. It has been steadily increasing. Okay, there are dips here and there. So some politicians have told the truth, some politicians have not, but it's basically a slightly upward sloping line. And here we see since the 40s, both are in the 40s, the payroll tax has very rapidly increased since the 40s to the 2010s. And you can see here, this dip is essentially due to the economic lockdown as a result of the hysteria about COVID-19. And corporate taxes has come down as a percentage of the federal budget. It now accounts only for about 10% of the federal budget. But individual W-2s now account for about 85% of the federal budget. So it is very important that you as a voter have your say, because you are the one who's paying for those taxes, for those budgets. And this was a surprise, that there was a steep increase in payroll taxes. It's not talked about. Most people are not even aware that payroll taxes has been going up quietly. It's like a silent killer, if you want to say that. So money going out, there's a category called mandatory spending. Social Security benefits, Medicare, Medicaid come under mandatory spending and accounts for $2 to $2.3 trillion. This, we'll come to that in a minute. And the rest of it is broken up into unemployment, small business, relief fund, DOT. And this was the one that's most interesting to me. This is the interest on public debt. That is, it's 9.5% of the use of the money is to pay interest rates on the treasury bonds. So it's between 5, 6% and 10% of the budget goes towards paying interest on treasuries. Okay. So just recapping, 35 mandatory spending is about 35% of the budget. The public debt, if you look at history, it's between 23 to 100% of GDP, of which I will explain the 100% is recent. And the interest outlay, that is the cash paid to service these treasury bonds, is between 1.2 to 3.9 plus percent, 3.1 plus percent. Careful. The term's interest outlay, it's the cash that was paid as a percentage of GDP. It looks nice and small, doesn't it? But look at that. If you use these numbers, you can convert back to effective interest rate, which is between 1.6 and 9.2. That means in this time period, very recent history, the US government paid 9.2% interest rate on its bonds. Just think about that. If the US government can pay 9.2% interest rate, what do you think our interest rate will be? So we have to be really, really careful about this deficit, because it's the deficits funded by the bonds. Okay, so how do we look at deficit? Deficit is the difference between money coming in and money going out. And it works out to be $1 trillion deficit in 2019, and almost 3 trillion, and almost 3 trillion in 2020 and 2021, which is between 5% and 15% of GDP. That's a huge number. Again, I must say, it is not Congress's federal budget. It's not their property. It's our taxpayers' money. We are paying for it because we account for 85% of the budget. So what we require is better stewardship. That's what we require. Okay, there's another piece in there that is not clearly shown. Payroll taxes, it's designed to pay for the mandatory spending, the Social Security, Medicare, Medicaid. It's underfunded by $1 trillion every year. What does that mean? It means that either we are going to borrow and borrow and borrow to make those commitments, or we're going to have to raise taxes. Even if we continue to borrow and borrow and borrow, those interest payments is going to come out of our taxes. So borrowing only kicks the can down the road a few more years. So this is a problem that needs to be addressed. Either, of course, our society, there are people who cannot manage. They do need help, genuine help. And so we need to provide some kind of safety net to help these people get back on their feet. So we do not cut their benefits. What we need to do is make the management of this disbursement of benefits much more efficient and effective. That's what we need to cut. If we do not want to see our payroll taxes going up, some more silent killer. Okay, now if you look at this, this is the interest that I was just talking about that was paid as a percentage of GDP. And the Congressional Budget Office provided a forecast from this point onwards, and it's about 3%. It's a very timid forecast, I would say. Having spent a good 10 years in stress testing with commercial mortgage-backed securities, I would say this is a very timid forecast. It's not even stress tested. So the budget, look at this. The public debt has been hovering around 40% since the 70s, plus or minus a little bit. It's now around 35. It was around 35% in the late up to 2007. And then 2008 onwards, it shot up to 100% of GDP. From 35% of GDP to 100% of GDP. Can you imagine that? That's because of quantitative easing. Yes, Timothy Geithner did the right thing by introducing the concept of wall of money. Yes, Ben Bernanke did the right thing by implementing that as quantitative easing, but it should have gone long ago. Because now with the supply chain issues, we are seeing it as inflation. There's no two way about it. This is excess money in the system. We're seeing it as inflation. So now we can get to defining the budget management. Okay, there's 3 simple rules. The deficit should not exceed 33% of the individual tax base. That means we have so much money come in, the extra that we spend, which we have not been able to collect, that 33% is the limit. That means if we have a tax base of 100%, the total spending should not exceed 133% of that tax base. And that's the funding rule. That's to make sure that we do not put our country in a situation that will end up as a disaster 5-10 years from now. The second rule is the disposable income rule. That means that individual taxes base should not exceed 80% of total receipts. That means the reason why I say that, because when we look at the historical data, we are a consumer-based economy. That means the more we take from the W-2, the less consumers have to spend in a consumer-based economy. That means the economy cannot grow, and we are no longer in a position to cause the economy to thrive. So that's why we need to limit it at a maximum of 80%. Ideally, I would say it should be around 65 to 70%. We will have a thriving economy because there's so much more cash for consumers, disposable income for consumers to spend. And the third one is the leverage rule. That is, see, the budget is like an income statement of a company. But the companies have a balance sheet and cash flow statement. And most people do not look at cash flow statements because it can be generated from the income and the income statement and the balance sheet. So the leverage rule is equivalent to the balance sheet covenants when you are doing commercial and industrial loan lending, which I've done in the past. So what this rule does is it sets the public debt not to exceed 40% of GDP, which is how we have been operating for a long while before quantitative easing came into the picture. So we have to restore that. And the other thing I suspect, because I've done a ton of modeling, the other thing I suspect is that this will bring us back to the previous type of economy we had without this excess amount of quantitative easing. Because the models, the econometric models we have built were based on a low debt economy, less than 40% of GDP. Now we have a debt that's 2 to 3 times what it used to be. The behavior of the money flow is different. And I question whether our current econometric models are still valid. They will still give you numbers. If you want to believe it, you can believe it. But are they still valid? So what's the implications? The implications of lack of discipline is that our taxes, this is based on just one factor. I did stress testing because I spent a lot of years in stress testing for mortgages, commercial mortgages. And I just did one factor. I didn't do the whole budget because that takes too long. And it shows that if we are not careful with our budget, the taxes can increase by 3 times. That means if today you're paying $1 in taxes, if something goes wrong, next year you might end up paying $3 in taxes. So, and nobody is going to accept that kind of tax increase. So what will happen? It will be postponed and kicked down can will be kicked down the road for our children to bear that kind of burden. That is the wrong thing to do. So the consequences of Build Back Better Act, it's a $4 trillion budget, probably even more. It is labeled as a $1.5 trillion budget because the progressives played games with the budget. If you are facile with financial statements, it's so easy to play games with numbers. You do all sorts of pro formas, but it only takes somebody with care and integrity to do pro formas that are carefully constructed. And you need additional skills because when you do a pro forma, you need to be able to do stress testing. Stress testing can be done on almost any financial instrument if you know how to do it. And when I looked at the CBO, I can tell you that they did not do any kind of stress testing with the congressional budget. And I would say CBO's approval of the budget is basically very timid. That's it.